Edna called me on Thanksgiving weekend and said, Jen, I need a speaker. Would you be willing to come in and chat with my group? So I put a little thought into what I thought might be some good end of year financial considerations. I saw Edna use the word tax. In full legal disclosure, I'm not a CPA, I'm a financial advisor, and while I work with a lot of our local TPAs and attorneys, I do not give tax or legal advice per se, but we will touch on a few things that are tax and legal related. So that said, because I'm a financial advisor and we're talking to a group, I'm not allowed to give anybody any specific stuff, so we're going to talk in generalities, but please don't think that any of this is a specific recommendation. It's highly recommended that you meet with your own financial advisor. If you don't have one, I can recommend a good one. Or your CPA to see how some of this stuff may or may not affect you and your family. But I know there's a lot of, because financial considerations can be pretty specific. I did a lot of handouts because when you go back to see if it applies, it might be nice to have something to reference back to. Here you are, my dear. Oh, forgive me, did I skip you, my dear? Here you are. Thank you, thank you. And because Edna asked me kind of in the last minute, we're going to do this kind of informal, if that's okay with all of you. In that little packet of handouts, forgive me, they're not in the best of order, you'll find a piece of paper that looks like this, and it says, your financial future is important. Let's get together to go through 7 smart ideas on this list. If you wouldn't mind pulling out that list, that's going to be kind of the framework that we're going to use to have a few, to talk about a couple of these topics. First on this list, I'm just going to be brief on this one, but the first one suggests check on your progress towards reaching your financial goals to assess whether your current roadmap still applies to the year ahead. That seems kind of big and lofty, but truthfully, as many of you are aware, have you ever heard that saying, if you don't know where you're going, any road will get you there? Much is true with your own retirement or legacy. If you don't know where you're going, any road will, oh, you need me here. Forgive me. Can you guys hear me all right?
No.
Okay, good. I'm not very good at using one of these or staying still, so you might have to remind me multiple times. Forgive me. Let's see. But having a roadmap in place is essential to make sure that you ultimately reach your goals. For retirement, those primary considerations is when is it, how much do I need to keep my purchasing power to keep up with inflation, and how long do I need that to last? And then of course, if legacy is important to us or leaving something for our heirs is important to us, then we need to make sure that we've fixed that into the planning as well. What I find oftentimes is that we overlook, we think all of our money can do so many things for us, and we oftentimes have those monies in our minds deployed at many different fronts, and so it takes a lot of thought and proper planning to make sure that we can reach all of those myriad goals that we have. So enough on that. This one I think is one of the most important for end of the year planning. Review your individual holdings within your portfolio. Think non-qualified or brokerage account types of portfolio. This does not apply to your IRAs because what happens in an IRA, much like Vegas, stays in an IRA, right? So, but look for opportunities for harvesting tax losses or potentially shaving large positions to realize gains over time. Just some ideas of where you might look for capital losses this year. Anybody have any wild guesses?
Energy.
Energy, bravo. Commodities, another one. Emerging markets have pulled back pretty significantly. Now, of course, all of this is in the context of your overarching plan, your tolerance for risk, and whether or not these are holdings that you should continue to own long term. Good investments go down in price, and it's not always a reason to sell them. But that said, for tax planning purposes, there can be really great reasons for us to harvest some tax losses. To get into the specifics of tax loss harvesting, there are very specific rules about how long you need to not hold that particular security in order for it to not be a wash sale. So I did print out some very specifics in your packet on capital gains and capital losses so that you can see what those specifics look like, as well as what those capital gains implications might be for you given your personal tax situation, okay? It's also a good time, and a lot of people, I find anyway, in the families that I serve, are resident to take capital gains, right? Oftentimes we've invested in companies years back and made terrific gains, and these securities may now be taking up a excessively large position in our portfolio. A good rule of thumb to consider is maybe not allowing any one security to become more than 5% of your overall net worth or portfolio investable assets, simply because it can become a systemic risk, right? Too big to fail, right? Well, gosh, if we have all of our eggs in one basket, that's essentially what we're talking about there. But don't be afraid to take capital gains and shape those holdings over time. Paying taxes is actually a good thing. It means you made money, right? So let's see here. If you haven't already, consider maximizing your contributions to your IRAs, your Roth IRAs, and consider increasing your systematic investing in your retirement plans for next year. It's always a good time at this time of year to make sure that we're looking at our funding levels and make sure that they're on track to give us enough when we need it. This is meant more for individuals, but many of you, being business owners, I can imagine, are also plan sponsors for a retirement plan. Not only do you have your own retirement accounts, but you might sponsor a simple IRA, a SEP IRA, or a 401k, or something like this for your businesses. If that is true, then goodness, there's a whole nother list of end of year preparation that you need to probably be considering if you haven't already. Depending on the type of plan that you have, there's different reporting requirements that you have every single year, as well as record keeping requirements of what actions you took. And so if you are a plan sponsor, I highly recommend that you review your summary plan description and look at what you've designed and make sure that you're living up to the letter of the requirements of that plan document. This is something that as a plan sponsor, a lot of folks don't seem to understand that you are the fiduciary of that plan and that your obligations go a lot further than simply handing out those enrollment forms every year. There are fee disclosure requirements, there are all kinds of different things that can apply to different sorts of plans. Given the late notice, I didn't have time to order many of these, but if you are a plan sponsor and you're not certain about what those requirements look like, I did bring a copy of this book I've got called Understanding Your Role as a Fiduciary. And if you would like a copy of that, I can always order some more, but you can reference it here today after the meeting if you'd like. Number 4 is very important, I would imagine, for this group. And that is or actually that was the contributions, but the flip side of that, if we are no longer saving for retirement, but if we are drawing down our retirement assets, if you're 70 and a half this year or north of that, make sure you remember to take your required minimum distributions out of all of your qualified plans. One common misstep that I have found in my practice with different clients that are of RMD age is that they've been told that they only have to take one required minimum distribution. But if you have multiple and while that's technically correct, right? But if you have multiple IRAs, it needs to be the amount of the collective IRA balances. I've seen this too many times to make it funny anymore, where folks thought, oh, well, I've got lots of IRAs. If I only have to take one RMD, I'll take it from the little account. Well, it needs to be based on that collective value and take a collective RMD. It can come from one if you need to. But the tax penalty for not getting your RMD out by December 31st is pretty hefty. Does anybody know what it is?
50%.
50%, exactly. I hope you've never paid it. 50% of the amount you should have taken. We really stick it to you if you don't take your RMD, because the IRS wants to have their opportunity to tax those monies that we've deferred for so long. If you have questions about RMDs, you're welcome to ask me after the meeting as well. Number 5 is about gifting. I made a special handout in there about the grandparents gifting opportunity, but consider, if you have no other purpose for your required minimum distributions, or if you have goals or aspirations, I guess would be a better word, of helping your children or grandchildren pay for college, using those gifting dollars into a 529 plan is a fabulous idea. These 529 plans are like a Roth IRA for college. All of the growth that happens there can be completely tax-free to that child if used for higher education. And at any FAFSA institution will accept $529. And that's just a wonderful way to make a gift go a lot further. And since it's the holiday season, and many of us tend to buy a bunch of junk for kids and grandkids that we really don't need, one thing that we've tried to institute in our family is rather than giving more stuff, that we put money in our kids and nieces and nephews and grandchildren's 529 plans. So that's become the new tradition in our family, and something you all might want to consider as well. At the end of the year, it's also a good time to take stock in family and making sure that we've protected our families appropriately. Many of us probably are no longer at the place where we have families that are dependent on us for our monthly income. I would like to think that at this stage in our lives, we've gotten to the point where we've got enough life insurance in place, we've saved enough for our retirements that our families would be okay without us. But in many cases, that is not the case. And so you do need to look at your life insurance coverages and make sure that you've got adequate coverage to protect your families in the event, right? Let's see. And I'd say those are probably some of the biggest ones. I'm equipped to talk to you guys about all of this kind of stuff, as well as where we're at in the economy, what our thoughts are about interest rates, what our thoughts are on China, heck, you name it. So I'd be glad to field any of the questions you have on this or any other topics.
Geez, if I'd given her a couple months, you think she'd get better.
Yes, I see some. Yes, sir.
Your sense on interest rates, number one.
Sure.
And the state of the economy.
Yeah, great questions. Fabulous questions that I talk about every single day. As far as interest rates are concerned, I might have not brought it inside, but I have a fabulous printout that I'd be glad to share with any of you that would like to see it. But the Fed has given us their projections of where interest rates will be over the next 3 years. They've published this data. The street does not agree with what they have said, but we'll get into that in a second. But the Fed has said that at the end of this year, our Fed funds rate would be, instead of at 0.2, 0.63. Don't quote me on that number. I want to say it's 0.6, 0.65. Yeah, right in there. By the end of this year, that would require a couple basis point hike right now. And there's a good likelihood that they'll raise rates in December. But I would say that more importantly than when they make that first rate hike, is that we've prepared our portfolios for the eventual rise in interest rates. They have those targets that they've projected out over the next 3 years have the Fed funds rate going up 3% over the next 3 years, about 1 to 1.25% per year. The market strategists from JP Morgan who print up the guide take some collective data and publish it to get some street consensus from, and what those numbers show on that same chart is that they believe it will actually be at about half that over the next 3 years. So slow eventual rise in rates is inevitable. So with that, we recommend that you diversify your bond portfolios and be very, very thoughtful about the mix in your asset allocation, your stocks, bonds, cash, and make sure that those are appropriate for your given situation, and they can be vastly different depending on what your financial needs and income needs are. But front-loading your bond portfolio, what I mean by that is having shorter maturities instead of a lot of long-term maturities is probably very wise. And forgive me, the state of the economy was the other half of the question?
Well, back to that, what you were talking about, I'm not familiar with all the different interest rates.
Yes, sir.
I am familiar with mortgage rates.
Sure, long-term
What is the impact on a 30-year note?
To rising interest rates?
To what is that you think your firm is going to go to?
We have our finger on the lever of the Fed funds rate, which is the short-term overnight lending rate to banks. Okay,
yes.
That is the only one we have control over. Long-term rates rise based on inflation and other factors that we cannot control. Historically, long-term interest rates have gone up as well, and we have had what's called the yield curve, a traditional yield curve, where shorter term, so our CDs, for 6-month CDs, very, very low interest. If you buy a 30-year T-bill, you get higher interest. Well, today we've been in a very flat yield curve for quite a long time. We're it's not one of these like it's been traditionally, but one of these, because we're getting a whopping 2.5 maybe on a 30-year treasury today. And after you pay taxes and factor in inflation, well, gosh, we might not have a real positive rate of return. And so, so long-term interest rates, I would expect will also rise, but honestly, it's impossible to know exactly because it's not a variable we can control. Okay? Other questions?
Eric?
Yes, sir?
And so, comparing a 401k account and a IRA account,
Yes?
and the possibility of rolling the 401k into IRA,
Mm-hmm.
or the other way if the IRA allows it, are there benefits for someone who's ready to start withdrawing minimum
Distribution?
accounts?
There can be.
To have
Mhm.
more money in the 401k account,
To have more in the 401k?
or to
Well,
have money in the 401k.
It kind of depends. I generally understand the question. The question is there a benefit to having money in your IRA versus a 401k?
And vice versa.
And vice versa. They are, from a tax perspective, essentially the same, right? It's tax deferred money. And all the IRS cares is that you take out your amount and pay tax on it, at least by the time you turn 70 and a half. The considerations that I think of when I think of an IRA versus a 401k are more about investment opportunities, what's inside of there. 401ks traditionally have a limited number of options, but usually a nice spread of high quality options. The fees of the IRA versus a 401k should certainly be considered. That's one of your biggest considerations. But you're going to have more investment options in a self-directed IRA. That can be good or bad, depends on how good of an investor you are. So, but there's no real tax benefit, or the only other thing I can think of that's coming to mind is that in a 401k you do have, but if you're spending it down, this is no longer relevant. But in your accumulation years, a 401k has one benefit that an IRA will never have, and that is that you can take loans against it. Is it advisable? No. But it's a feature of a 401k that does not exist with a traditional IRA. I hope that answered your question, but I don't know that there's one that's necessarily better. It comes down to preference and what you're trying to achieve. Yes, sir?
And so then after a person retires and they're taking their minimum withdrawals out of their IRA and 401k, can they take a loan out against it? And if they do, is that money taxed?
I would highly unadvisable when you're already taking distributions. You would just take your distribution. I can see no positive reason to take a loan against a 401k. Whether you're allowed to or not depends on how your plan was written, and every plan is different because you have the right to design it within the parameters of ERISA, so which is the law that governs these kinds of plans. And so I can see no benefit to using the loan feature. It would just draw it down your value faster because you're now paying interest, right? Usually a low interest, but interest nonetheless. Did you have a question, sir? I feel like I skipped over a little bit of your question there. I forgot to come back to it, and that was the economic backdrop. We actually, there's some really positive things that I would say that the news media is not highlighting enough that I wish more people knew. Unemployment's fabulous. It has come down to just above 5%, and we believe we'll be south of 5% in the new year. We have a tightening labor market, and that is where, now what I'm saying is nationally. I'm not talking about Port Angeles local economy, and that's obviously a distinction we need to make here. But as a nation, we have unemployment going south of 5% potentially in the new year. We believe that trend will continue. We do have some drag. There are a few pockets of concern with the high dollar is one, and that's hurting our revenue today. A lot of folks don't seem to realize, I've had a lot of clients coming in asking about GDP growth slowing. Why is GDP growth at 2.2, 2.3%? I thought we were on track for 3 plus. It's actually earnings, which by the way are positive again. The energy companies have made huge advancements on their balance sheets, cutting costs, etc., to give positive revenue in general over the last quarter back into the energy industry. They lost money for 2 quarters, now we're getting back into positive, but it certainly isn't their former glory, right? So when you solve for energy earnings, and one other variable that is silent and people have missed out on is the dollar. The dollar is raised, is up, I want to say about 19.9% year over year. It's a relative number. So relative to the euro, we're up about 15% on the euro. And so if we just use Procter & Gamble as an example, Procter & Gamble's probably selling about the same amount of toothpaste in Europe as it did last year, isn't it? But when they take that revenue and they go convert it back to their US balance sheet, they have 15% relative value. That hurts their earnings. A strong dollar hurts US balance sheets and earnings. And so that's why we're seeing slower growth. We'll probably have a strong dollar for at least a couple more quarters because of Europeans devaluing their currency, doing quantitative easing, much like we did a few years back, right? So that said, we might have a few more quarters of this, but overall, the backdrop, we believe, is for slow and steady rising stock prices over time. That's a lot, sorry, but that was essentially the meat of your question, I believe. Yes, sir?
You talked about the lowering unemployment rate. How much of that is due to people who have exhausted their benefits or just dropped out?
Yeah, that's a great question. That is a great question.
What is the labor participation rate now
yeah.
compared to what it was? I've heard it's at a 38-year low.
Mm-hmm. The labor participation rate is actually not as bad as people have kind of made it sound, I would say. I think a lot of people have used that as well. Everybody's gotten out. So of course unemployment's low, nobody's getting back in there. It's an easy thing to brush off or say, or chalk it up to. But the reality is we have a lot of people that have exited the labor force because they did not expect to have physical incapacity as early as they did, right? We think, gosh, okay, well if I have to work till 70, I'll work till I'm 70. A lot of people can do it, a lot of people can't. A lot of people that have been terminally unemployed coming out of the recession fell by the wayside. You know, they made some poor choices, and we've seen a lot of substance issues, right? And so they've become permanently unemployable. But those numbers are actually pretty small. And forgive me, I'm a little out of date on my numbers. It's been about 3 or 4 months since last I had my update on where labor participation rates are. But I remember my impression at the end of that last update was positive, and that we seem to have a lot less slack there than the news media would have us believe. It's all been quantified at this point, and our economists feel pretty strong about the overall labor market. And I apologize, that wasn't very specific. Any other questions? Okay, sucking all of the energy out of the room, I am done.
Thank you, Jennifer. Any other business?
Your own financial advisor. If you don't have one, I can recommend a good one. Or your CPA to see how some of this stuff may or may not affect you and your family. But I know there's a lot of, because financial considerations can be pretty specific. I did a lot of handouts because when you go back to see if it applies, it might be nice to have something to reference back to. Here you are, my dear. Oh, forgive me, did I skip you, my dear? Here you are. Thank you, thank you. And because Edna asked me kind of in the last minute, we're going to do this kind of informal, if that's okay with all of you. In that little packet of handouts, forgive me, they're not in the best of order. Going, any road will, oh, you need me here. Forgive me. Can you guys hear me all right?
No.
Okay, good. I'm not very good at using one of these or staying still, so you might have to remind me multiple times. Forgive me. Let's see. But having a roadmap in place is essential to make sure that you ultimately reach your goals. For retirement, those primary considerations is when is it, how much do I need to keep my purchasing power to keep up with inflation, and how long do I need that to last? And then, of course, if legacy is important to us or leaving something for our heirs is important to us, then we need to make sure that we've fixed that into the planning as well. What I find oftentimes is that we overlook, we think all of our money can do. And Edna called me on Thanksgiving weekend and said, Jen, I need a speaker. Would you be willing to come in and chat with my group? So I put a little thought into what I thought might be some good end of year financial considerations. I saw Edna use the word tax. In full legal disclosure, I'm not a CPA, I'm a financial advisor, and while I work with a lot of our local CPAs and attorneys, I do not give tax or legal advice per se, but we will touch on a few things that are tax and legal related. So that said, because I'm a financial advisor and we're talking to a group, I'm not allowed to give anybody any specific stuff, so we're going to talk in generalities, but please don't think that any of this is a specific recommendation. It's highly recommended that you meet with so many things for us, and we oftentimes have those monies in our minds deployed at many different fronts, and so it takes a lot of thought and proper planning to make sure that we can reach all of those myriad goals that we have. So enough on that. This one I think is one of the most important for end of the year planning. Review your individual holdings within your portfolio. Think non-qualified or brokerage account types of portfolio. This does not apply to your IRAs because what happens in an IRA, much like Vegas, stays in an IRA, right? So, but look for opportunities for harvesting tax losses or potentially shaving large positions to realize gains over time. Just some ideas. You'll find a piece of paper that looks like this, and it says your financial future is important. Let's get together to go through 7 smart ideas on this list. If you wouldn't mind pulling out that list, that's going to be kind of the framework that we're going to use to have a few to talk about a couple of these topics. First on this list, I'm just going to be brief on this one, but the first one suggests check on your progress towards reaching your financial goals to assess whether your current roadmap still applies to the year ahead. That seems kind of big and lofty, but truthfully, as many of you are aware, have you ever heard that saying, if you don't know where you're going, any road will get you there? Much is true with your own retirement or legacy. If you don't know where you're going,